Buckle up, everyone, and start preparing yourselves for a recession in America, potentially starting in 2022. How do I know this? Well, because the most reliable recession signal and predictor in US history just flashed red this month. That's right, everyone. The yield curve is flattening and it is about to invert. And every single time that this has happened in recent US history, we have had a recession shortly thereafter. And you can see that in most periods, the yield curve, in this case, the difference between the 10-year and the 2-year spread on US government bond yields is positive, indicated by the blue sections of this line. Normally there's an upwardly sloping positive yield curve, but then we have these very rare, unique situations where the yield curve inverts and goes negative, meaning that the 2-year government bond all of a sudden starts yielding more than the 10-year bond. And what we can see here historically over the last 50 years is that every time we see this inversion happen, we have a recession shortly thereafter. That's what the yellow bars are representing, periods of recession in America. And you see every single time we had yield curve inversion happen right before the recession occurred. And what's scary about today in 2022 is that, look at this, folks, we're getting exceedingly close, very close to having yield curve inversion. Right now, the 10 to 2-year spread is about even, and very shortly, as the Fed continues to hike rates, it's going to go negative. Now, I'm sure a lot of you are looking at that graph and saying, wow, it's amazing how accurate the yield curve is in terms of predicting recessions. But what I think a lot of you want to know about is timing, right? You want to know, when do I start selling stocks? When do I start selling real estate? When do I potentially need to worry about losing my job in a recession based off this yield curve inversion? And I'm going to address that more later in the video so you guys can understand timing and when you need to really start preparing for the recession. But first, you all really need to understand what the yield curve is and why it's such a relevant predictor of where the economy is heading. Now, we're going to get things started by looking at what the yield curve in America looked like in March 2021, 1 year ago. We can see here what the yields were for the 1 month, 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, 20 year, and 30-year government treasuries. And what you can notice that in March 2021, 1 year ago, this yield curve had a nice upward slope. The 2-year yield was only 0.14%, while the 10-year was 1.73%. So we had a positive differential, and this is indicative of a healthy economy, basically expectations for robust economic growth in the future from the bond market, because this is essentially saying people who buy government bonds want higher compensation for buying longer term securities because they expect to have good investment opportunities elsewhere. They expect inflation to increase. So they're saying to the government, you got to pay me more to lock up my money long term. And this is a normal, healthy yield curve and the sign of a growing economy. But now let's layer in what the current yield curve looks like in 2022, this orange line, and you can see it's a much different situation. The 2-year yield is 2.4%, the 10-year yield is 2.4%, and basically any duration US government bond you buy, you're getting paid basically the same yield today. Make no mistake, this is a bad sign for the US economy that these short-term government bonds, 1 year, 2 year, 3 year, 5 year, the yields are surging, meaning the government is having to pay people more interest to induce them to buy the bond, is a signal that the short-term risk premium has increased and that institutional bond buyers, whether they be commercial banks, pension funds, life insurance companies, or other governments, are seeing problems ahead in the short term. In lieu of buying these government bonds, these institutions are likely hoarding cash right now, preparing themselves for problems they're going to develop in the economy and financial system. And what makes the bond market in the yield curve such an amazing indicator is that not only is it very accurate in terms of predicting recessions, as I showed you earlier, but it's also the timing. The yield curve and the yield curve inverting is probably the earliest warning signal we have in the US economy that a recession is coming. And to get a sense for this, once again, take a look at the difference between the 10-year and the 2-year spread. This is a chart I showed you earlier. You can see that when it inverts, we have a recession shortly thereafter. But now we're going to layer on unemployment rate, the green line, which is kind of the most typical indicator we have of the broader health of the US economy, the percentage of people that are unemployed who can't find work. And what do you notice is that every time the yield curve inverts, we see that the unemployment unemployment rate bottoms out a couple months after, and that only a couple months after that, the unemployment rate surges. You can get a good glimpse of this by measuring the date when yield curve inversion, the 10 to 2 year inverted, compared to when unemployment peaked and we started to have job losses after that point. You can see that we had inversion in August 78 and then job losses started in June 1979, a 10-month lag. Then we had inversion in September 1980. Job losses started a mere 3 months later in December 1980. Then we had inversion in January 1989. Job losses started 3 months later in April 1989. Then we had inversion in February 2000. Job losses started only 2 months later in April 2000. Then we had inversion in January 06. Job losses started 14 months later in March of 07. And then finally, we most recently had inversion in August 2019. Job losses started about 6 months later in February 2020, of course coinciding with the COVID pandemic. And so everyone, this is serious. This is no joke. This data is saying that every single time the yield curve is inverted over the last 50 years, we've had job losses start occurring within typically 6 months. That means we don't have long for the US economy to start to go down the tubes. And in my opinion, not only are we going to see job losses, we're going to see a stock market crash and a housing market crash. Both the stock market and the housing market are the most overvalued they have ever been relative to the underlying fundamentals such as earnings, income, and inflation. And so that means once you introduce job losses into a system where these two asset markets are tremendously overvalued, they are going to go down. Me personally, I'm holding a lot of cash right now because I think there's going to be good buying opportunities in both the stock market and the housing market over the next couple years. And I want to have cash and reserves to be able to take advantage of those opportunities. Now, before signing off, everyone, I do need to reveal one thing to you, and that's that the yield curve, while it's a very reliable indicator of future recessions, is not a perfect indicator. There was one instance in the last 50 years where the yield curve did invert and that we did not have a recession. And that was in 1998. You can see that the yield curve went negative in 1998. The 2-year exceeded the 10-year, but we did not have a recession shortly thereafter. In fact, 1998 was one of the best years for the US economy in its history. And so that begs the question, could the inversion that we're about to see today be a false signal, potentially be another instance of, in 1998 where the yield curve inverts, but we don't have a recession? And to see why we had a false signal in the mid-90s and that today I don't think is a false signal, we need to talk actually about the broader US economy and Americans' feelings towards the US economy, what consumer sentiment is, because this is an important indicator as well of a potential recession. The fact that consumer sentiment, this orange line, as reported by the University of Michigan Consumer Sentiment Survey, is now at nearly its lowest level of all time in early 2022. This is signifying that Americans and consumers don't feel good about the future prospects of their finances and the economy. You can see it was a very different situation though in 1998. While the yield curve was inverting, consumer sentiment and confidence was actually at an all-time high. So that's potentially one reason we knew that even though the yield curve inverted, the underlying economy was still strong because consumers thought it was strong and were going to spend money and were going to make investments. Today, it's a completely different situation. Consumers hate this economy. They don't feel good about the future. And the fact that this is coinciding with the yield curve inverting is a big warning sign. And so this is the double whammy that the US economy is facing in 2022, that both the yield curve, which indicates the bond market's perceptions for economic growth, as well as consumer sentiment, which indicates Americans' perceptions of growth, are both saying at the same time that a recession is coming. That has really got to cause you to stop in your tracks if you're someone who's investing right now or buying a house or banking on continued economic growth. Take a look at what both the bond market and Americans are predicting. It is not good, and I suspect the result will be a recession starting in late 2022, coinciding with lots of job losses and a stock market and a housing market crash. Now, if that's not enough evidence for you, also consider that there's other recession indicators that are flashing red right now as well. I did a video a couple weeks back on gas prices and how anytime we've seen a big surge in gas prices in America over the last 5 decades, a recession typically follows. Moreover, I also did a video a couple weeks back on inflation and how sudden surges of inflation historically also tend to cause recessions. I'm going to have links to those videos in the description. You should check them out if you want to understand these other indicators like gas prices and inflation more. But the broader point to understand in the US economy is that we have a lot of different forward-looking indicators all pointing to a recession starting in 2022. Now, I want to hear your thoughts on this topic. What do you think about the yield curve? Do you think a recession is coming? And most importantly, how are you preparing for this recession? Let me know in the comment section below, and also make sure to smash the like button. That's the best way to support this channel. In addition, also make sure you're a subscriber. Hit that subscribe button. I just passed 160,000. I want to get to 170,000 in the next month. Help me out with that. Become a subscriber. Make sure your notifications are turned on.